Well, hello everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I am a coach and senior manager with Schwab, and this is Trading a Smaller Account. I have spent the week installing and getting things ready with a new system. I do not have my drawing tool, so if you're wondering why I'm not using it, that is why. So just have a little patience, and you'll have to follow my mouse around on the screen today. But other than that, we've got a ton to cover today. One of the questions that I get asked a lot when we do a survey is, how do you pick what you pick? So, to use for example trade. So we're going to look at a whole bunch of potential example trades and kind of walk through the thought process a trader might have on, do we trade this or do we not, and why or why not? And then what type of trade might we place to accommodate that? In addition, we're going to do a little bit of trade management, look at some of the trades that we have placed in previous classes. We had one today, FANG, that hit a target, so we're going to look at that as well. On Monday, I had to leave abruptly because my system decided that it was tired of working and shut itself down. So I did re-record that webcast, or record that webcast after the fact. You can access that by going to the playlist that I know that Scott Thompson has already posted in the chat. It will also be in the comment section down below. And we did some very short-term trades in that class because we were trying to embrace volatility and the gift that it can provide us. And we still have a fair amount of volatility going on in the market. And we're going to talk about how we might navigate that as traders. So, I want to thank Scott Thompson for being here in the chat with me today. One of the trades that we're going to look at is a 1 ATR trade. Scott years ago used to teach a class when I was a client that was a 1 ATR strategy class. And so if you're wondering where I got this idea from, yeah, you can type a thanks to Scott in the chat. So, and I want to thank each and every one of you who is here and who brings this class to life here on a Friday the 13th, no less. And it has been a typical Friday the 13th so far, but I think we're going to have smooth sailing through this class. So here we go. Just before we get into the thick of things, a quick reminder that options do carry a high level of risk and aren't suitable for all investors. Also know that we use the paperMoney software application on the thinkorswim desktop platform. It is a brilliant place to learn. Make sure you understand your trading plan, your trading strategies, and the mechanics of how to place trades and exit trades on this platform before you consider doing that in a live account. There are some nuances and differences between a live account and a paperMoney account. One is that short option positions will never be assigned early in paperMoney. That can happen in a live account. So I've already said we're going to do a quick market overview. Kevin Horner and guests do a great job 4 days a week of that market overview. On Friday mornings, he teams up with Mr. James Boyd. You may want to put that one on your list to make sure you catch that as the market opens. Again, our focus will be on placing some new example trades and a bit of trade management as, you know, the cherry on top. So let's get over to the thinkorswim platform. Why it's not wanting to bring it up. Let me see if it's underneath. There we go. Okay, so let's start with looking at the S&P. And, you know, Chicken Little, it's now official. She's out doing laps, you know, around the yard. And there's a lot of anxiety and uncertainty in the market. And, you know, this seems to be a news-driven market. A single tweet from you-know-who, you know, can have an impact on the market. There's a lot of geopolitical events that are influencing the market. And it behooves us to be aware of that. And, you know, the way I drew this line, and this isn't a new line, I drew this back probably, you know, in this time frame. But it's still, you know, support and resistance are ranges. And, you know, this is kind of knocking on the door, but it is below the 10, it's below the 30, and it's below the 100-day moving average. So none of those like warm the hearts of a bullish investor. Yeah, somebody's asking if I can review the Nvidia iron condor. I not only am going to review it, but we're going to place another iron condor trade on Nvidia today. So we're going to have a quick look at the Dow. Like that looks even more unsettling than the NDX, does it not? Than the NASDAQ? Yeah. You know, like, and this is not an insignificant pullback here. You know, so if we go from this high down to here, you know, that's 7%. So, you know, it's not you know, a trend reversal yet, but it's starting to look like a bit of a correction, isn't it? Yeah. Yeah. And then what about the VIX? So the VIX is still, you know, up in the nosebleed section. Like if we back the truck up a bit, you know, when we look at the 1-year chart for the VIX, I mean, it's only been here other than like earlier this week, once, twice, 3 times a lover, 3 times in the last year. So like we're up in the nosebleed section here. And so what can that provide for us? An opportunity, you know, to look at maybe some shorter term trades and selling strategies if the expectation is that there's an opportunity for this to come back down. And if it stays in this neighborhood, well, you know, then if we have a shorter term time frame, time decay is going to happen on a faster rate of return. And when I recorded that session on Monday, what we looked at, and in fact, what we did was, let's come to the monitor tab and the account statement. And I'm just going to go 5 days back, which takes us to Monday when I placed these example trades. We did a bunch of short put verticals on Monday and a short call vertical. And all of them had expiration dates like less than 2 weeks out. Because the volatility was so high, it gave us an opportunity to make a pretty reasonable return in a very short-term time frame. Okay, but you can go back and watch that in the archives. I think it was just over half an hour long. Now, somebody asked if I'd look at the Nvidia trade, and I was having some system issues. We put this trade on Friday, last Friday. And so, you know, it's a 2-week trade and we got 48. I wasn't able to put it in as an iron condor. So we did a credit spread sandwich, and we did it as a credit spread sandwich. And let's bring Nvidia up. So what do I mean by that? Well, if you're not familiar with this strategy, in an iron condor, and in this class, I will say, if you're new to this, feel free to type a greeting into the chat so we can welcome you. But this is an intermediate level class, and this is where I don't have my drawing tool and it's driving me kind of crazy. So what we've done is we put a short call vertical on because Nvidia, since September, has been largely trading in this range between 170 and 195. So we did a short call vertical at the top because we're expecting it to stay below 195. And we did a short put vertical on the bottom at the same time, expecting it to stay above 170. And we call this an iron condor. I also affectionately call it a credit spread sandwich because we don't want the mayo to ooze out between this slice of bread and this slice of bread. As long as Nvidia stays under 195 and above 170, we'll have a successful trade. And then I went in afterwards and put in an exit and said, hey, when we've got 80% of our max gain, I would like to exit this position. So if we come and we look at Nvidia, we put in an exit at 10 cents on the short put vertical, 9 cents on the short call vertical. So we're willing to leg out of the trade. Okay. Yeah, and somebody said they just, you know, they had an example trade on Nvidia and they closed it out and they called it a base hit. We're up a whopping $73. It's lost half its value. So, you know, on the call side, you know, and why are we not losing as much value on the put side? Well, some might argue that, you know, maybe more people are buying protective puts and that's kind of keeping the put values a little higher. I'm not sure, but we've still made 30 bucks on the put side. And this has 7 days to expiration. And years ago, we were layering in trades on Apple. And unless you've been with me for 6 or 7 years, you may not remember that. But we did a short put vertical every week on Apple because it was just, continuing to trend up. But, we were just doing it as an example trade. But here we have 7 days to go. Could we come out with the gift of volatility currently and Nvidia being such a heavily traded stock? Could we let this one continue to percolate? And could we come out and come out 14 days, so to March 27th, so 2 weeks from today, and do the same thing again, kind of a wash, rinse, repeat, where we have more than one load in the washer at the same time? Yeah, so somebody's saying, what should I look for to exit? Well, we're looking to exit when we've got 80% of our max gain on each side of the trade. And right now we're a little shy of that. But on Saturday and Sunday, when the markets are closed, time decay is going to continue to be working. To what extent? Well, if I come here and change this from Barb's Basics to the Greeks, how much should I expect this to go down? Well, by 3 cents, like 15 and 12. So, time decay is going to continue to be working on both sides of this trade, and if it loses another net 4 cents a day on this side and 3 cents a day on this side, that will start, getting us to where we want to go. We want this to be to 10 cents. And so on Monday or Tuesday, and your target might be different. Jim Wood is saying his target 75%. We put in an 80% target. But on Monday, we could look at it. And if we're at 75%, we might say, hey, good enough, and close it out. But we're going to look at coming out one more week and looking at the same strikes and saying, could we do another one where we're looking at this 195 strike? We've got a 2 cent bid-ask spread. These are very heavily traded. So if we come and we look at my basics that has volume, like at 195, we have 1,800 contracts. So this 18,000 contracts. So I'm going to look at this, this 195, and I'm coming up to sell iron condor. And so this is $2.50 wide. But on the bottom, I don't want the 192.50. I want it to be that same strike, the 170. So I'm going to come down and make this 170 and then 167.50. So I'm getting 90 cents. Well, how much am I risking? I'm risking 250. And this is why a lot of people think iron condors are kind of delicious, because we do, short put verticals or short call verticals, and we're just getting one credit. This way we're collecting a on the top side and a credit on the bottom side, on the call side and on the put side. And we're risking 250 in total. So if we say, well, what's 250 minus 90? So I'm risking $1.60, and I have the possibility of making 90 cents. So if I take that 90 cents divided by $1.60, that's a 56% potential return. I didn't kind of do my math right there. 90 divided by 1.6. I'm rounding. So that's a potential return of 56% for a trade we're in at most for 14 days, and we have a defined risk. So if we did 3 of these, how much could we lose? We could lose $486. The most we can make is $264. And so we are going to put this. Now I'm going to come back to edit this. We're going to, and we can go in and put in our exits individually, or we could come to our single order And this is coming up in the very corner of my screen here. Let me see if I can get to it. If I hold my tongue just right, maybe. Okay, first triggers all. I'm going to right click, create an opposite order and say, hey, when this entire thing is worth about 16 cents, 17 cents, let's buy it back. So if I take 80, and I get that by just taking 88 times 0.2, 17.6. So we could make it 18 cents. Okay, and we're going to put this in our iron condor bucket. Okay. Yeah, so is there any real advantage to break the iron condor into two separate plays? You know, like put the put on. And I really like this question. And I did a strategy like that on the SPX. Now I looked at the SPX today. I was going to look at an index, but you know, I think because of the geopolitical thing and the response to sometimes a Twitter post, like it can throw us off. So Nvidia has been kind of steady Eddie here. And I would say I really love that idea to Kang Milla. You know, if we were up here and let's say on this day when it started to pull back, we could have put the short call vertical on this day and then the short put vertical on this day for the same expiration. But we're only going 2 weeks out and we have the advantage of two things. One, Nvidia is currently sitting like right in the middle of our range. And we're getting a similar amount on both sides. And I always go and look at both sides of the trade before I put it on. Because if I'm getting 90 cents on the short call vertical side and only 10 cents on the short put vertical side, it's not worth putting the put vertical side on. So I always go in and check each side individually first. And I did that before the class started. And each side was contributing a similar amount. Okay, but if it had been up here and rolling, now when it gets up, if it comes back up to the short call vertical side, like to the our resistance level, then what you may want to do is close out the short put vertical side because it will be worth a lot less. And then if it comes back down to here, you can close out this side. So you don't have to leg in and leg out. You can leg in and leg out. Yeah, so that's, I like the way you're thinking there. Okay, so we've reviewed one and we've placed a new trade. Let's come and look at MCHP. So this is Microchip Technologies. If we come and look, and so one of the things that I did was I came in and I said, okay, let's look at this watch list. Let's look at the S&P 500 sector indices. And when you look at these, and you know, usually we're looking for like, hey, what sectors have been really strong? But if I click the 3-month, we can see that, you know, at the very back of the bus, the one that's been performing the worst has been technology. So if we wanted to do a bearish trade, a short-term trade, where might we look? Well, maybe we'll look at like who's like in the doghouse right now, and that's tech. And so when I came through, like now one of the challenges, and then financials haven't been, you know, doing so hot either. Financials have been right at the back of the bus with technology. So we're going to look at a couple of financial stocks as well. But when we look at Microchip, you know, what would you say this pattern looks like? Here's where I would use my drawing tool, which I can't use, but you know, I can use this drawing tool. So like it tried to kind of recover for a couple of days here, but then it came down. Go ahead and type into the chat. Do you see what I see? I'm seeing a bear flag. And so yesterday would have been our entry when it traded below the low of this day. So we could have gone in at the beginning of the day yesterday, but we weren't together yesterday. So, and today it's down just a little bit more. So we have this trend continuation. So we haven't, missed it completely. But could we look at this and say, hey, on an average day, Microchip moves about, $2.94. And so I'm going to change my calculator to a scratch pad. We're going to come down to the very bottom. And so this is a bearish 1 ATR example trade. And we're going to look at MCHP. And why did we pick this? Well, we picked it because it's in a sector that's not doing well. And we're looking at placing this trade in a time when the market is pulling back. And we have a bear flag with what we call a cablowed entry. So close below the low of the high day. Okay, that's our cablowed. So we have a close below the low of the high day. So, we're checking the boxes here. And then this stock, it's down 4% year to date. And so if we say, okay, so the 1 ATR on Microchip is 294. And then I'm going to hover over this candle and say, okay, today's high, 64.08. Today's low, 61.99. So our target on this is going to be 61.99 minus 294. And that is 59.05. And then our exit, if it does not go according to plan, is going to be today's high, 64.08 plus 294. Now, I do have an example trading plan for a long call with a 1 ATR strategy. So you would have to flip it and reverse it, kind of. But once I get all my systems back in order, I will record one for a bearish trade as well. And so we want to go in and put this in. Now, this is a $67 stock. So our degree of confidence is relatively strong that we could afford to buy a put. And if we come out to April, now, why do we want to come out to April? The Nvidia trade, we picked March 27th, 2 weeks. Well, with March, like with the Nvidia trade, we were selling something. So we want time decay to be clipping along lickety split. But when we're buying a put, we'd like time decay to be as minimal as possible. And so we want to come out at least 30 days or 20 days plus the number of days we think it'll take. And when we look at volumes here, we have a lot higher volume here than we do on the weeklies. So it's, and that's one of our rules when we're placing a trade, is that we want there to be volume. We want there to be a tight bid-ask spread. So if we look at this 60 strike and we're between 270, 290, it's 20 cents. So that's less than 10%. So if we right click here, we want to buy. And we're just going to do a plain old buy. And this is just a faster way to put this in. And then I'm going to right click anywhere on this and say, we want to create an opposite order. And then we're going to make it a market order that is good till canceled. And then I come hit our disappearing, reappearing sprocket. Okay. Where did my mouse go? There it is. Okay. Bring this up. And now my rule is I always put in the target first. So I want it to be less than 59.05. Or I want to exit if it does not go according to plan, if it goes above 67.02. And then the rule is if by end of day Monday it hasn't hit the target, then I'm going to go in and adjust that stop. and I'm going to snug it up to 50 cents above the high of above the close of Monday. So this is 67.02. Because this we want to be a very short-term trade. You know, we don't want it to lollygag about and then have time decay eating our lunch. So somebody's saying, would you get more credit for the April trade for Nvidia? Yes, if we went out to April, we would, but then we'd have to be in that trade for 35 days. And with all this market uncertainty, we're saying I'd rather do, instead of doing, you know, one trade for 35 days, I'd rather do 3 or 4 little trades like for 14. Does that make sense? And maybe I could make more in total than I could make on that one trade. Okay, so this is a long put. So this is a bearish trade, right? Right. That's why I'm buying a put. Like, I talk this way like out loud to myself when I'm placing trades, just so you know. This is why it's nice to have a dog, because then you don't sound quite so crazy. You can pretend you're talking to your dog. But we want to buy a put at 290, and then we want to sell it when it either goes below 59.05, check, or above 67.02, check. Does that make sense? Yes. The stock is trading at 62, so that's below, that's above. Okay. And this is in our notes, and this is just for us to see. This is a 1 ATR target trade. Fire in the hole. Okay, so we'll make sure that one gets filled. Now, let's look at CVS. It's actually CVX. Oh, without. So CVX, you know, is kind of, we've got this one, a doji pattern here. It hit a new high yesterday. And if I'm looking for examples for bearish opportunities, might this be one? And I'd say no for 2 reasons. Why is that? Well, look at the uptrend. Like, this stock is up 30% year to date. And then if we take a look at our sectors and sector strengths, what sector's been leading the pack? Would that be energy? Is this an energy stock? Yeah. So this is the strongest sector in the S&P 500. And this is a stock that's up 30% year to date. So would I place a bearish trade on that? No. You know, that's just a counter trend trade. So we wouldn't do that trade as a bearish trade. Now, would we place a bullish trade on this today? Well, no. Why not? Well, it's bullish, but this is saying it may be pulling back. Maybe it's going to create a bull flag. So we're going to keep this on our watch list, but we're not going to trade it bearishly. Okay. So that's CVX. Now, how about Goldman Sachs? You know, it's in the financial sector, and the financial sector's been kind of, you know, not doing so hot, sucking wind. And, you know, it's down today, right? Yeah. But you know what? Where was our close below the low of the high day? It was here. It was on Wednesday. So, you know, this on Tuesday, if we'd been looking at this, it was saying like, hey, pay attention. I may be continuing this downtrend. And on Wednesday, you got, yep, here's our entry, but we've now missed the entry. And this is why it's important to be watching these on a daily basis, you know, because, you know, you don't want to, like, the horse is out of the barn on this one. And so we've kind of missed that entry. And so we're not going to do that one either. Now, how about American Express? Well, that one might look a little more interesting. I mean, it's down 20% year to date. Not that, you know, we're happy that a stock is not doing well, but if we wanted to do a bearish example trade, you know, this was in this upward channel and then it broke below this support level. And then this support level looked like it said, yeah, I was a floor, now a ceiling. And we've had these like lovely bear flags. And then what have we got today? Well, if this was our high day, you know, and yesterday it kind of tried to rally, but it looks like this 10-day moving average is continuing to act as a ceiling. You know, we might be a little early. It hasn't closed below the low of this day yet, but might this be downtrending? And could we do this as another one ATR example? Now, this is a more expensive stock. So, you know, we don't want to risk more than $500 on one trade. You know, could we buy one? And where would we put our targets? Well, here's our second example. Oops. And our one ATR on that is 961. I'm leaving it, I'm going to call it 961 because I did the math earlier. And we all know I'm math averse, so I don't want to do it again. Our target on this. So again, I just looked at what's the high of the day. I may have to do it because it's may have gotten lower. Our 305.70, whoops, on this one. 305.71 was our high. And oh, it went down to 389. I had a different number. So 389. So minus our 961. I'm going to do that on my little calculator here. 389 minus 961. You guys feel free to double check my math. 291.28. So our target is going to be 389 minus 961. Now, could we put a different target in? Yeah, we could look at this and say, hey, our low on this day was 292.43. So we could do a swing target, you know, and that has a different trade management algorithm to it, 291.28. But we're pretty close on this with the one ATR target to the, yeah, we're pretty close to that swing target. And then our exit would be today's high, 305.71 plus 961, 315.32. Okay, so again, we're going to come to our trade tab. Now, when I look at this April, like our at the money strike is 12.75 to 13.35. We have 635 contracts. You know, this stock does trade on average over 1 million shares a day. So check for volume. This is like what, 60, about 60 cents. Is it below $1.20? Yeah. So we're good there. It's less than 10%. But this is not in our snack bracket. Like, because we could lose this entire amount. You know, so we need to be in the $500 tax bracket. And so you might say, well, I don't like that because here, if it goes down $1, I'm only going to get 18 cents of, like, it's going to decay by 18 cents. Or this is going to go up by 18 cents. Sorry. This is going to go up by 18 cents. But if I look at 18 cents on, let's just take this 435. So if I take 18 divided by 435, that's a 4% return in one day if it were to move 18 cents. And we want it to move like $9.61. If I look at this moves 45 cents, but it moves 45 cents on 12.75, or actually, if I'm using this number, 13.35. So if I take 45 divided by 13.35, like that's a 3.3% gain. So as a percentage, this 18-cent gain is more significant than the 46-cent gain on the $13 option. So out of the money options aren't always like a terrible thing. So I just wanted to give you another way to frame that. So how many are we going to buy? Well, we're only going to buy one. Why? Well, because we're risking $435. And even though we're doing this because we want to make money, if it goes wrong, the most we can lose here is 435. So we're going to make this first trigger sequence, right click, create an opposite order. And then we're going to make this a market order that's good till canceled. And then we're going to go into our disappearing, reappearing sprocket and our conditional order and say, hey, if and or when this goes below 291.28, get us out. Or if it goes above 315.32, get us out. Okay. And again, when I look at this confirmation order, how much could I lose? 435. Is that acceptable? Yes. It's saying I could make 26,000, but we aren't going to wait for it to go to zero. We're going to wait for it to go to 291.28, which is, below our current price of 301. If it goes wrong, we want out at 315, right? That makes sense. We're going to put this into our long put with a 1 ATR. And why are we doing this? Well, what if there is some news or some tweet or something that comes out and the whole market rallies? So, and that could come out on the weekend. It could come out next Wednesday. It could not come out, or there could be something that negatively impacts the market. But we're looking to just kind of get in, be small, nimble, and quick, make a little base hit and get out. And if we're saying, well, how much might we make? Well, if we come and we look at this, we can come to Barb's Basic and change it to Theo Price and say, hey, if this comes down to about that 291 level or up to 315, 291 and 315. So I'm going to, the first thing you do when you click on this is you say reset. And so let's say by today's the 13th, by next Tuesday, so St. Patty's Day, this has come down by about $10.10. And then if I just click anywhere, just hit your enter button, it'll say that'll be 291.40. So that's close to our target. That this option might be worth in the neighborhood of 571. So if I take 571 and divide it by 430, that's about a 32% return. Now, what if instead of going down by that amount, what if by next Wednesday or Tuesday, it went up by about 10 bucks? What is it now? 301 to 315. So if it went up by $15, whoops. $316. So that would have us out. We'd have lost more than 50%. But on Monday, if it hasn't hit our target, we're going to tighten our stop up. Now, there's nothing to say that American Express couldn't gap up or down. Is my target wrong? It should be. Oh, let me see. American Express. -3. Oh, let me go to American Express. Let's look at our weight condition. Somebody said I put the wrong number in there. So let me just check on that because I don't want it to trigger and get us out. So our target is 291.28. So I think that's correct. Or 315.32. So I think that's okay. Exit is wrong. Oh, I made it. Yeah, no, it's 315. It is 315. And that's what it's supposed to be. Because when we look at American Express, it's It's trading right now at 301. So we want out if it's at 315. Okay. So we've done, when we come and look at our trades here, we've done an iron condor on Nvidia, and then we've done 2 bearish trades, one on a tech stock, MCHP, and one on a financial stock, American Express. Okay, I know that I've been asked a couple of times to look at our short put verticals. So we've only got 5 minutes left, but let's go have a quick look. So when we look at our short put verticals, Apple is not looking so hot, and Caterpillar is now not looking so hot, and McDonald's isn't looking so hot either. But when I look at these three, McDonald's looks the best of the worst because it's up, like we've made money on that one today. So when we look at MCD, these all expire next week. So we'll look at them all on Monday because, you know, our rule is we don't let these go into expiration. It's sitting, we want it to be above 325, and it's sitting right at 324. And so we're just down a smidge, but it seems to be kind of finding some support here. This was a previous resistance type level. But, you know, if this doesn't come up on Monday, we would close that out. Caterpillar. So Caterpillar, and this is, the closer we get to expiration, the higher the risk of it being assigned. But this does not look like it's going in the right direction. And so we might just say on this one, you know what? We have a low here and a higher low. On Monday, if this isn't moving up, we're going to close it out. Now, could we close it out today? Absolutely. And one of the things I thought was like, hey, we're down $200 on this. We've got to be close to our max loss, but we're $100, over $100 away from our max loss on this, even though it's below both strikes. And so you may say, well, you know, time decay might work in our favor. If the stock moves up instead of down on Monday, that might help us. But either way, on Monday, we'll make a decision. And Apple, I looked at Apple, and Apple was kind of flirting with a support level. And it is through our strike. But you know what? We'll wait. And on Monday, if this hasn't moved, whatever has happened, we'll likely take action on Monday on that one. Somebody's saying, oh, I see dark cloud cover. If you don't know what that means, let me just, you know, I like your powers of observation. Let me just bring this up here. So if you come to Trader Talks, this is where you'll find the archives for this class. And there's a button in the bottom right corner of your screen. If you haven't subscribed, you're going to want to do that. I'd also appreciate it if you hit the like button. It just, one, it sounds like applause to Scott and I, but more importantly, what this does is it moves it up in the YouTube algorithm so more people can find this. So I created a playlist called the Trade Management Mini Sessions. And if you're wondering what dark cloud cover is, here's a short video. I've got 13 so far in this series of little snack bites on different candlestick patterns. Also, when I talked about example trading plans, here's the long call with the 1 ATR, which, you know, the long put is basically just flip it and reverse it. And then there's a short call vertical and a short put vertical example trading plan, which we kind of modified a little bit and smushed them together to make the iron condor trading plan. Somebody asked me if I would create a specific trading plan for the iron condor, and I will do that, and I will post it here. I just have some things to line up with my new system before I can start creating that kind of content again. And then if you're new to all of this and you're wondering how I got the profit and loss columns and like all of that good stuff, there's a bunch of short videos down here, and, you know, on just like how to customize your charts and all that kind of stuff. So you can come down here. These are in turquoise, the ones specific to that. Okay, so guys, that's a wrap for today. Thank you so much for joining me. Don't forget to follow Scott and I in the Land of X, Barb Armstrong CS, Scott Thompson CS. I'm now also on LinkedIn. You can find me there. Have a great weekend. Get out and hug someone you love this weekend, and watch out for black cats. It is Friday the 13th, so step carefully. Bye for now, everyone.